we sometimes have a tendency to being too black and white. And sometimes the people that believe in climate transition is the biggest problem for investors to invest in transition companies. Nobody wants us to invest in oil and gas, even if it's an oil and gas company that has a strong transition plan.
Welcome to The Greener Way. I'm your host, Michelle Baltazar, Executive Director of Media at FS Sustainability. We are recording on Gadigal land, and we pay our respects to the traditional custodians of country and elders past and present. Today's guest is Bjarne Graven Larsen, founder and Chief Executive Officer of Qblue Balanced. Qblue Balanced is a Copenhagen-based asset manager founded in 2018 by Bjarne, who was the former CIO at ATP and Ontario Teachers' Pension Plan. Bjarne, thanks for joining us.
Thank you for having me, Michelle.
Now, we are tackling quite a big topic here, and it's about how can we measure climate transition. And it's especially important because right now, as we do this podcast, the government has just completed the Economic Reform Roundtable where we're talking about, well, should we change the superannuation performance test and how we approach that and incorporate all the latest discussions around sustainability, decarbonization, electrification? And one of my contacts said, you have to talk to Bjarne because he'll be able to provide you more context on that. Now, Bjarne, you have to sit back and relax. I just need to provide our listeners with some context on where you're coming from before we talk about climate transition.
Sure.
So you are a pension fund and financial sector veteran with more than 30 years of experience in the industry. And as I mentioned, you were the former CIO and executive board member of Ontario Teachers' Pension Plan, OTPP, which is one of the world's largest and most sophisticated pension plans based in Canada. But before that, before you founded Qblue Balanced, from 1999 to 2011, you were also the CIO and executive board member of ATP, Denmark's largest and Europe's fourth largest pension fund that blazed the trail when it came to sustainability integration. Amongst other things in your very impressive track record in this space. But once again, fast forward to 2018, you founded Qblue Balanced, and I believe the conversation we're having today about climate transition is really at the heart of the fund that you've founded. So firstly, we are very much interested in the sustainability factor, or I know that you have your sustainability cube, where in fact you look at a company's climate transition score, ESG industry leadership score, and UN SDG score, among other things. So you have a couple of other factors there. But just drilling into climate transition, what are your thoughts? Why is the industry struggling to measure it, and what can we do about it?
I think one of the big issues, well, one thing is measurement, as you said, but I think you have to go one step further back and talk about definition. How do we define it? Because before you have defined it, you can't measure it. And I think, today we have, our approach is systematic and data-driven. So when we have defined what we mean about climate transition alignment, then you can start figuring out where you can find relevant data sets and how you can measure it so it doesn't become too subjective. And I think that's the main problem with all discussions about sustainability. They are poorly defined. That's why we said, let's define sustainability as companies' activities that create additional societal value. So we try to not make it normative, but make it more a question about contribution to creating welfare in the society where you operate. And being an economist myself, we started to think about, well, that's really what you call externalities in economics. That is consequences of economic activities for a company that is not measured in their GDP contribution. So that's our thought process of how you should approach climate transitions. You should really try to figure out, so how does a company affect positively or negatively societal value creation? And of course, it's easy to focus on carbon emission as the first thing. But what we said is, well, it's a little bit more tricky because you could either go for how a company does today, to try to measure their current emissions, scope 1, scope 2, total emissions per $1 million revenue emissions, per $1 million market cap. So we have a lot of emission data where you take it like absolute emissions, but also relative to your revenues or market capitalization. And that, of course, gives you an idea about where is the company compared to their peers, their other industries. But we said, well, this is not really saying a lot about the future. It's just saying something about the times we live in right now. And sometimes it could be an indicator for a company that had a strong position, strong climate transition, outlook. But it could also just be because the company is in an industry. If you are in a professional services company that does not have any production, you might not have a big footprint, and you might look very attractive, but you might not do better than your peers. So I think that is one. So we defined it. Let's see if we can figure out which companies create societal value now. So now is one part of it, and that's all the things I talked about. But if you look forward, if you try to figure out if a company is well positioned for the future, we have two different approaches there. One is to measure the outlook for reduction of carbon emissions. And you can see that changes the whole idea about societal value creation, because if you look at low emissions, it's certain companies that have low emissions. But if you look at reductions or ambition to reduce, so that is really our progress score. That is, it continues two parts. One is how credible a reduction plan do you have? And I think it's really important to say how credible a reduction plan, because often people measure ambitions to reduce, but there's so much greenwashing going on. There's so many companies that are net neutral or almost gross neutral in their emissions in 2050, but they haven't really started yet. So we like companies having thorough planning and ambitious goals and medium-term goals and so on. So we measure as one part of the credible climate transition planning, we measure the plans. And as another part, we measure credibility. And then you can ask again, how do you measure credibility? It turns out our portfolio manager in this area, Philippe, had just visited Australia to talk about these topics recently. She done a lot of research, and I don't know if it was a surprise, but it turns out that the best proxy for companies that are well positioned to reduce in the future is company that has reduced in the past. So if you should forecast which company is going to lower their emissions going forward, would you think you should take the ones that already has a low emissions, the ones that are doing well today? That's not the case. They tend actually to increase their emissions a little bit if you look 5 years ahead, whereas companies that in the past 5 years already have shown ability and willingness to reduce their emissions, if you forecast where they are 5 years ahead, they would typically continue to reduce their emissions going forward. So when it comes to these progress score for climate transition, we look at a combination of how ambitious and detailed are your plans for the future, and two, how much have you shown willingness and ability in the past to actually reduce. So we combine those two score, and then we get a progress score. So that's one part of the progress. One part is how well are you positioned to reduce in the future. But as we all know, it's much more fun to, and maybe it also has more potential if you can come up with new ideas, new technologies, where you can actually change the technology you use so you will reduce reduction. So therefore, a second part, besides from the credible reduction of our progress when we look into the future, is how strong are you on green innovation? And we've spent, so that's another, again, so you can see the idea. The idea is you take how well are they doing today? you find data for how well is a company positioned for the future, where we also take green innovation that is based on patents. So a lot of companies have a lot of technology, some of it already being produced and some of it ready to be produced in the future. So we have found that the company's ability to take out patents is the best indicator for if they will benefit and create societal value from new innovation that can help society and other companies to reduce emission. So we spent a lot of time using AI, big data, to create our own data set by downloading patent data from all over the patent organizations globally. So that's a good example of it's not always you have all the data that you want. There is great organizations collecting data, but sometimes when you have defined what you want to measure, you can't get the data out there, so you have to create them themselves, and that's what we do as well. And then finally, the third sub-dimension to climate transition, so actual progress, and then also how is a company perceived by the general public. Sometimes the wisdom of the crowd is very strong, and sometimes the data sets are influenced by companies' own reporting. You see a tendency for large companies, they have better web pages, they have more policies, so they look more climate transition friendly, but it might be greenwashing. So if you say that there is the wisdom of the crowd, so what we do is that we have spent some time working with a partner on creating a data set on sentiment data in relation to climate transition. So we've taken the SDG number 7 and 13, the two that has most to do with climate transition. And we are every day reading more than 1 million news articles from serious outlets. The machine learning algorithm is reading them. Then they try to look for news stories that is related to a specific company and to a specific one of the climate transition topics. So if there is a story saying, for example, that Microsoft is now using 100% green energy for their data centers in the US, for example, that would be a positive news story for Microsoft relating climate transition. So we look for that as well as the third supplement. So you can see, I don't think there's one answer to how you define it. We define it as creating societal value, and then we measure it by taking as many data we can find that are reliable in how do they do today, how are they positioned for the future, and how are they perceived by the general public.
It strikes me as the best of two worlds, the past and the present. I mean, this seems to be the first instance where past performance is kind of indicative of future performance in terms of the emissions.
Yeah.
So I didn't expect a short explanation. I mean, it does feel like it's a whole of system approach to saying, yes, we can measure it, but you do need a massive engine like AI to go over patent data, to go over news sentiment, and a whole host of things. But what I'm hearing here is, yes, you can. There is a way to do benchmarking. There is a way to gather data in a way that is meaningful enough, especially when the stakes are high, Bjarne.
Yeah.
We're talking about super funds responsible for tens of billions of dollars. So we're not talking about lunch money.
No.
When we look at the money at stake here. Now, I want to then ask about the super performance test, because that's one of the reasons I wanted to talk to you is that the conversation here is that we have these amazing super funds who are championing this idea that we are long-term stewards, custodians of money, and we are going to back a lot of these renewable companies, even at the cost of short-term returns or short-term performance. But the conversation is, well, that's not reflected in the current metrics or calculations. So in many ways, we are getting punished for taking on the risk. And so there are calls for reform. What are your views about this? I mean, what if the government says, you know what, we don't have to actively engage to do this. We don't have to redefine the performance test. This should organically happen as you are finding companies to back as your fund managers are competing for money. What would you say to that? Can we just kind of, how aggressive do we need to be to say this is going to impact fund performance materially? 5%, 20%, 30%.
I think there's several problems you've seen around the world with systems where of course, it makes a lot of sense that you test performance and you want to make sure that all superannuation funds or pension plans in any country try to serve the purpose they have been formed based. So it's very easy to understand, but I do think there is cases out there in Peru and in Sweden where they've tried to do the same thing to have like performance test, and I think it typically has ended in tears. Maybe the Australians are smarter in the sense that if you measure all companies not by the standards set by their own board, but instead of the same standard for all pension plans, you always came back to what John Maynard Keynes said so correctly about human behavior, that it's better for your reputation to fail conventionally than to succeed unconventionally. So if there is like that kind of benchmark, you create a huge incentive to do what everybody else does. So in the end, you don't necessarily do the things that you believe are the right things, but you do the things that you think that everybody else will do. And that's what you see now. Sweden is reforming their AP pension system again, because first they had one AP fund like 30 years ago, and then they said, no, we need to split them up. We need to have four. So they created AP 1, 2, 3, 4. And now they have decided to merge them again because they invested in the same way, but some do it. I think it's always the question. So I think it's a very difficult task. You want to have transparency. You want to have benchmarking. You want to compare who's doing well and who's not. But if you measure them to compare returns over a period with each other, then you probably end up having them investing more or less in the same way, because there's not a lot of incentive to do something differently. And I think that has typically been difficult, but there is not really a good solution to what is the alternative. I do think that you can, and I think that's the difficult thing right now. I see that being a problem in a lot of pension systems. People have committed themselves to net zero. A lot of pension plans have, but it turns out often the financial upside is in transition companies, not in the ones that already have low emissions. And I talk to a lot of pension plans around the world that says to me, but it's a problem because we want to invest in these transition companies, the ones that goes from being high emitters to low emitters or have a strong business proposition. But we can't, because it would be in conflict with the net zero commitment that our board has set. So I think in some way, I think the key to success from a financial perspective is to find a way where you can invest in higher emitters if there is, if they are on a good track. So I think it is more tricky, and you probably have in some way to figure out how to give some credit for companies that take the brave way, where it might look as if you have higher emissions, but if you have a strong business idea for why this will work, you should be allowed to do so. But it is very difficult. If you deviate too much from your peers, then nobody really wants to go in that direction.
Second last question from me. Back to the super performance test. Is it possible that perversely, by not looking at the impact of climate transition, by not rewarding pro net zero, arguably pro net, because we are amongst friends here, we don't have skeptics probably don't listen to FS sustainability or the greener way. But can that perversely hurt performance if we just stick with what we have right now in terms of the super performance test, which excludes or doesn't really look at the climate transition and decarb work that a lot of super funds are focused on?
If you look at how has the companies that have the strongest climate transition scores in the way I just defined it, how have they actually performed in the market? So we have reliable data on this in this front going back to 2017, and in the period from 2017 until October 21, it was a big, strong bull run for transition or climate transition strong companies. It was a really, really strong period. And if you had invested in the companies that had the lowest emissions, the best progress score, so the best outlook for the future, whether it was patents or reductions in emissions, and the strongest sentiment score, you would have beaten the benchmark significantly in that period. So 17 to 21, if you had invested in the climate transition strong companies, you had outperformed the benchmark by a wide margin. The opposite has been true. 22 wasn't like an interim year, but since 23, it has been a very difficult strategy to run because the companies with the strongest climate transition, they have underperformed in 23, 24, and the beginning of 25. I think to your question, since the cycles in climate transition are very distinct and different from the MSCI World or any other international benchmark for how the equity markets are doing, you could easily have 5-year periods where you did much better than your peers and 5-year periods where you did worse because it tends to run in cycles. And sometimes, as I said, in the period from 2017 till 21, I think 21, it got probably a little bit overheated. Everybody wanted to invest in green companies. So I think the pricing became a little bit too high on a lot of those companies, and a lot of them has been struggling since then. If you don't take it into account, it will probably be difficult to run a strategy like this if everybody else is not, because then you know that you could be underperforming 5 years in a row when there is a headwind for these investments, even though maybe over a 10 or 15 years period you would benefit from it. But it's very difficult to forecast these cycles, and therefore I think people will be reluctant to invest in it. And I think that's probably, if it's not part of your benchmarking or your peer group analysis, then you're back to the John Maynard Keynes quote: do you want to succeed long term in an unconventional way by deviating from your peers, even though it works? If you risk having underperformance in the next 5 years, probably not. So I think that's what I found in general, that people don't want to, even though they believe in things and think you can, from a financial perspective, make money long term. If they run a 3 to 5 year risk of underperformance, they tend not to do it because that's the planning horizon for boards. And no CIO will probably survive if they have 5 years underperformance in a row. So I think that could be a problem, as you indicated.
Yes, especially now here in Australia, where we have a regular test on the default fund, if you like. And if that default fund underperforms, then there is bloodletting, and you can't escape the short-term performance. Beyond anything else you would like to share with our listeners on this very important topic of climate transition?
Yeah.
How do we factor it in our investing?
I think one of the things, as you said, we are among friends and believers, and I think one thing that I and others that do think that climate transition is a really important factor to take into consideration, and it's going to drive a lot of things in the future. I think we and again, being among friends, we sometimes have a tendency to being too black and white, and sometimes the people that believe in climate transition is the biggest problem for investors to invest in transition companies. Nobody wants us to invest in oil and gas, even if it's an oil and gas company that has a strong transition plan. I think my recommendation for all of us would be to accept the gray areas a little bit more and find dark gray companies that are becoming light gray and maybe even turning green in the years to come. Because I think I truly believe that progress is our friend. And as I said, it's not necessarily the companies that are already there that will be the ones that will change the world. So I think that's probably something I'm struggling a little bit with. How can we make that happening? Because it's so easy for journalists and all of us to just reject doing business with companies in the oil and gas industry. So I think thinking about how we can support the oil and gas companies that have a strong plan for transitioning, I think that's a key area to focus on.
Well said, well said. It's a case of almost the vice companies turning into virtue companies at some point, rather than a clear divide between the two. But yeah, so if you're listening to this and you've drank the Kool-Aid, we have to be more self-aware that it's not a hard, black or white discussion. But truly, Bjarne, on a serious, looking at it as an investor, we are in that journey. A lot of investors barely understand what the ASX 200 is about, let alone say, well, black and white, we only have ASX 12 that we can invest in. Once again, Bjarne, thank you for joining us.
Thank you for having me.
This is The Greener Way. I'm your host, Michelle Baltazar. Thank you for listening.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.